We're American Barrick Group 1, presenting on the American Barrick Gold Corporation. American Barrick is a gold company founded in Toronto, Canada. American Barrick was formed in the early 1980s, originally as an oil and gas exploration company. Its founder, Peter Monk, was able to introduce cutting-edge strategic risk management practices to bring American Barrick quickly to the heights of success. Today we will overview an introduction to Barrick and Peter Monk, the value chain and competitive advantage, evolution of Barrick's hedging strategies, and our recommendation, analysis, and conclusion of American Barrick's risk management program. Barrick Gold Corporation was founded in the early 80s in Toronto, Canada. Originally formed as an oil and gas company, they quickly moved to extraction and selling of gold products. Barrick sought opportunity to become the largest producer in the Americas region and move away from South African gold, which dominated the marketplace at the time, due mostly to the abundance of naturally found gold resources and unethically sourced cheap labor produced by the global apartheid. Peter Monk, the founder of Barrick, was a skilled businessman with a proven track record of success. However, Barrick had no prior experience in the mining and exploration of gold and was neither educated in gemology, mineralogy, or geology. Peter Monk graduated from the University of Toronto in electrical engineering. From there, he moved to produce his own manufacturing corporation that made electronics equipment. From there, Peter Monk was able to raise several other businesses, producing a valid track record as a successful entrepreneur and business person. Peter Monk had an excellent vision for strategic risk management. Monk used a variety of gold hedging strategies to create competitive advantage inside his company. In a 1991 annual report, Barrick is quoted as, "Our unique gold hedging program gives American Barrick extraordinary financial stability. It protects us from the impact of dips in the gold price, allows us to plan our cash flows with confidence, and, in combination with rising production, offers investors a predictable, rising earning profile in the future." Barrick implemented the use of derivatives and other financial instruments to create a unique and complex system of strategies in order to help eliminate geopolitical risks, produce conservative financial management plans, emphasize strong liquidity in their balance sheets, create affordable capital, reduce volatility during market downturns. Barrick primarily focused only on acquiring assets in the Americas. North and South America, open pit mining and underground mining were popular methods for Barrick's extraction. Open pit mining allowed for the stockpile of ores to meet market demand and easy transportation. Underground mining allowed for Barrick to focus specifically on the acquisition of one type of ore or another, but also had high initial investment as well as complicated engineering concerns. One critical point of Barrick's acquisition strategies was to find properties that were within close proximity of another, oftentimes within 1 mile radius of their other mines. Goldstrike Mine, for example, had 58% effectiveness in 1989, 3-year improvement, and produced over 4.5 million ounces in 11 years. Competitive advantages can also be established through the acquiring of profitable mines or land to mine. Unexpected outputs from some of these acquisitions were able to set Barrick far above their competitors. For example, unexpected output from the Goldstrike and Mico mines gave Barrick a competitive advantage that they did not foresee. as the Goldstrike mine was expected to initially output 600,000 ounces and ended up producing over 20 million. Barrick's competitive advantages can also be established by finding cheaper ways to lower the operating costs associated with mining and producing. Barrick created competitive advantages at this step not only through sharing in mines that were close proximity, but sharing in the processing infrastructure with other industry leaders. Cutting expenses and increasing production capacity were a main focus of Barrick Gold. The ability for Barrick to sell their gold can be established in the use of their derivatives. Barrick was able to hedge their downside, allowing them to sell gold between 1984 and 1992 at an average of approximately 5% above the market price, establishing an approximate difference of $18.66 on each ounce traded. Gold financing was incredibly easy for Barrick as they were able to make very unique contracts. They were able to finance startup costs without over-leveraging, built the first gold trust traded on the Canadian exchange, created bullion-backed loans, and gold-indexed bonds. They hedged against the gold price and their risk of market downturn. Advantages provided in these gold hedging methods allowed Barrick to finance new mines much more rapidly than other industry leaders. Their hedging technique also allowed them to continue to progress even throughout troughs in the price of gold. Forward contracts, a popular financial instrument used by Barrick to hedge against gold drops in gold prices in the 1980s, provided several advantages. Protected Barrick from the downside of gold price risk, allowed for Barrick to produce reliable cash flows on their pro forma statements, but also provided the disadvantage of eliminating potential upswings in the price of gold. Option contracts were also used. Collars are a popular method used to close off the upside and downside of what an asset's movement may do. Improving on these derivatives contracts, forwards allowed Barrick to keep upside of gold risk manageable. Advantages: options contracts prevented losses from drops in gold prices, allowed Barrick to profit from small increases in gold, and allowed for free hedging if the price fell between the put and call strike prices. Disadvantages: short time horizon did not meet long-term needs. Spot deferred contracts were similar to forward contracts but with multiple delivery dates. Each delivery date provided Barrick the option to execute or call the contract, close the contract in an opposite trade, or roll it to new strike prices. Advantages: strong financial positions allowed Barrick to dictate favorable terms inside their contracts. These contracts were able to serve as risk hedging tools for long-term time horizons. Spot deferred contracts kept some of the profits from upswings in price while hedging losses. A disadvantage of spot deferred contracts is that they could become very costly if the gold price became suddenly more volatile. Successful risk management. Barrick felt that investors no longer valued their hedging techniques. They stopped hedging gold price risk. Barrick was willing to give up short-term profits when hedging through the 80s and 90s, but not long-term profits through continuing their hedging in the 2000s. When the market crashed in 2012, their stocks dropped along with their competitors. In order for a risk management program to be effective, it must be maintained even when it doesn't seem to be valued. Our recommendation, American Barrick was able to effectively implement complex financial tools to create risk management strategies that helped the company grow at an incredible rate. Barrick was able to beat the market and impress investors with earnings that exceeded expectations year over year through market troughs and commodity downturns. We would have recommended that Barrick had stayed on course with their gold hedging methods, opposed to removing their hedging strategies completely from the company's risk model. We believe that some of the failures and crashes that Barrick experienced in the late 90s and 2000s could have been heavily mitigated or otherwise prevented through the continued use of Monk's strategic risk program. Thank you.